Hi, I'm Pattu from freefincal. Many readers ask us after looking at our articles and our handpicked list of mutual funds, plumb blind, why you are not recommending mid cap and small cap mutual funds. In fact, recently we received a very strongly worded letter uh, demanding reasons for that. So I thought I'll make a list of reasons. So in yesterday's video, we talked about the rolling returns of Next 50, Nifty 50, Nifty Mid Cap 150, and Nifty Small Cap 250. You would have seen that the Nifty Small Cap 250 consistently underperforms the Nifty Mid Cap 150. So this is the reason why we choose Nifty Mid Cap 150 as the benchmark for actively managed small cap funds, in addition to, of course, mid cap funds. So it's very easy to beat the small cap index, but the small cap index itself is constantly underperforming the mid cap index. So if you want to pay big money to a actively managed small cap fund, it better beat a mid cap index. Otherwise, you have mid cap index options available today for investments. That they have the high tracking error is another matter, but you still have passive options which are better than actively managed small cap funds. So let's do this evaluation. So regular readers and viewers may know that we use something called rolling returns per outperformance consistency. So we look at every possible 3-year return, 5-year return, 4-year return between 1st January 2013 to the latest date, let's say September 2023, and we find out of all possible, let's say, 5-year returns, how often has a mid cap fund outperformed the Nifty Mid Cap 150 total returns index? So, if you look at it that way, there are 24 mid cap funds with a 5-year history, and only 6 of them have bet the Nifty Mid Cap 150 with 60% or more performance consistency. That is the number of times they bet the index divided by the total number of rolling returns. That should be 60% or above. If you use that as a filter, usually we use 70% as a filter, but I'm now relaxing it to 60%. Only six funds qualify with 60% or more outperformance consistency. If you consider 4-year periods, there are 25 funds, and only 7 have bet the index, the mid cap index, with 60% consistency. Over 3 years, there are 26 funds with a 3-year history, and only 7 again have bet the Nifty Mid Cap 150 with 60% consistency. If you look at funds that match over 5 years, over 4 years, and over 3 years, then it will be only 2 or 3 funds. You can get the data from our monthly equity mutual fund outperformance screeners. So you can see that investing in actively managed mid cap funds is basically a gamble. Most of them don't manage to outperform the mid cap index. Now, coming to small cap, many people believe, especially young people with not enough money to invest, they believe that if you invest in small cap, you will get better returns than mid cap and large cap. This is nonsense. Now, there are 15 small cap mutual funds with a 5-year history. Only 6 of them have beaten the Nifty Mid Cap 150 with 60% or more outperformance consistency. Over 4 years, there are 20 small cap mutual funds, and only 11 have managed to match our 60% criterion. Over 3 years, there are 21 funds, and again, only 10 have managed to qualify with 60% or more outperformance consistency with respect to the Nifty Mid Cap 150 TRI. So it's basically half the funds in the category, or often less than half the funds in the category. Only those qualify. So basically, it's luck. Today, people will say, "Oh, I am investing in X small cap index, Y small cap, X small cap fund, Y small cap fund that has given me great returns." But that's in the past. There's no way to find out whether that will be the case in future as well. And if you actually do a deep analysis, you will find out that performance comes in cycles. Sometimes it outperforms, sometimes it underperforms. If you look at rolling returns and look for consistency, many of them do not qualify. So like I said, that is the reason why usually we demand 70% outperformance consistency, but we relaxed it by 10%, still the performance is quite bad. So that's why we can't bring ourselves to recommend any actively managed mid cap and small cap funds in our plum blind list or any of our articles for that matter. Definitely avoid small cap index funds. There's no point investing in them. They're just too many stocks, very large tracking errors, and they anyway underperform the mid cap and Nifty Next 50 often. At the time of making this video, at the time of writing this article, a Nifty mid cap in 150 index, it is not a terrible idea, but I think that there will be large tracking errors, and especially when there is a market downturn, there is significant volatility, then the fund manager may struggle because of liquidity constraints, because of the mid cap stocks and how the equity market is designed. So at the moment, we can't bring ourselves to recommend a passive mid cap option as well. Maybe things will become better in future, but we will keep an eye on this segment and find out how that goes. People often ask how about quality factor indices like momentum, value, quality, etc. I would again avoid that. The definition of all quality factors, value factors, they're all very arbitrary. Maybe momentum is slightly better defined, low volatility is better defined, but momentum is too volatile. Whatever it gains, it can quickly lose. So I'm not a big fan of that. If you look at the quality 50 mid cap 150 quality 50 index in 2022, in the calendar year, that quality index gave a return of minus 5.4%, whereas the base mother index, the mid cap 150, gave a return of plus 5.45%. So that's a huge gap, like more than 10% gap. And that's just not on. I mean, investors don't really like such things. They look at past performance, they look at colorful analysis made by AMCs, but how many of them will appreciate this kind of bad performance? Even in the case of Nifty Next 50, many people started questioning Nifty Next 50, and of course us for our recommendations the moment the things started becoming bad. So most people can't handle it. So I would say avoid factor indices as well. At the moment, we still believe Nifty Next 50 is the best option for those who want to look beyond Nifty 50. I'm not saying you should look beyond Nifty 50. Sensex or Nifty 50 is more than sufficient. But if you want to look beyond, if you must look beyond, then Nifty Next 50 is a low cost option with no fund manager risk. Take care. Bye bye.